Hi, I'm Jacob Hornberger, president of the Future of Freedom Foundation, and this is this week's issue of the Libertarian Angle, the show that brings y'all the principled libertarian perspective on the burning issues of the day. I'm joined by my co-host, Richard Ebeling, professor of economics at the Citadel, and today we're joined by a special guest, Jim Bovard, who's an established columnist all across the country and been senior fellow here at FFF for, 30 years or so, Jim. And so writes for us every month in our monthly journal, Future of Freedom. And he's just finished a great article in the New York Post and just got one published there on the issue that we're going to be discussing today, which is the banking crisis. And unfortunately, Jim isn't joining us by video, just by audio. And Richard's theory on that is that he doesn't want to be held guilty by association. He's afraid the government might hold him guilty by association. But Jim, welcome to the show.
Hey, thanks for having me on. I appreciate that. As far as Richard's theory, actually, it's my theory that you've got a podcast that already has two guys with movie star good looks. And I don't know if it can handle adding a third with a good face for radio.
Well, Richard, I think he's got a good point about that. I can't argue with him. Can you?
Well, I always look forward to seeing Jim on the radio.
That's a good answer.
All right. The burning issue of the day is the banking crisis. Now, we've got two banks that failed, and the government is,
two?
Well, at least two so far.
I think there was, I think they put down at least another third one, but maybe I'm incorrect.
My understanding is two, but okay, let's say it's three. That we've got a situation where the depositors at these banks were withdrawing their money in mass, especially after they heard the bank was in trouble. The bank had been investing in what are supposedly the safest and most secure investment, government bonds. And as a result of the Federal Reserve's monetary antics, skyrocketing interest rates in a very short period of time, it put strain on the bonds in those banks. They were incurring massive losses on the books. But as the depositors started to withdraw their money, in part because the tech industry was suffering financial losses because of the Fed's interest rate policies, but also because depositors were finding out that there were higher interest bearing investments that they could invest in. Well, then the old-fashioned run of the bank starts, and the bank has to liquidate these bonds at a loss because the bonds that they invested in at a lower rate of interest had reduced value and compared to the high interest rate bearing securities that the Fed's high interest rate policies were causing. So they ended up with a massive bank run. The government has announced that it's bailing out at least these two banks. If there is a third bank, I have no doubts they're going to bail out that bank. They tell us that everything is safe and secure, that there's nothing to worry about. Everybody stay calm. Well, of course, my question is, if that's the case, then why'd you have to bail out these institutions? If everything's safe and secure, you shouldn't have to bail out anybody. They've got, as y'all know, insurance coverage, and I put insurance in quotation marks, from the FDIC, up to $250,000 in deposits. But they've decided to cover everybody, millions of dollars of so-called uninsured deposits. And my hunch is that the reason they did this is because the whole system is not as safe and secure as they're saying. So I'll turn it over to you, Richard. You've written this great book for FFF, Monetary Central Planning in the State. You and I have been talking about this for a long time. In fact, it was just a few weeks ago on Libertarian Angle that I suggested that, we may very well be approaching the crack up that is inevitable in this kind of system that's been going on for decades. The question really is this just a blip, or is this a real crack in the monetary dam? What do you think, Richard?
Well, I think that, just to elaborate on a few of your points, it is true that the bank managers made a bad decision in investing in long-term government bonds with a high liability the ability for depositors to withdraw their money in the short run. But we have to also ask the question, how did this come about? And the ultimate culprit of this, and for some of our viewers and listeners, this may not come as too much of a shock, the Federal Reserve System. The fact that the Federal Reserve had been pushing interest rates down for over a decade to near to the 0 point, adjusted for inflation by the Consumer Price Index for a good part of that time in the negative range. So what you had a situation is that, the Silicon Valley Bank had put a lot of its deposits into these longer-term government bonds at a very low but supposedly secure rate of interest because of a dearth of investment opportunities with these deposits over the last couple of years because of the COVID business. And then what happened is the Federal Reserve, as if it's a shock, I can't believe this is happening. The Federal Reserve suddenly realizes that its own monetary policy is starting to generate price inflation, and therefore starts the traditional policy to raising interest rates to lower the cost of borrowing to reduce investment borrowing. And suddenly with those higher rate of interest, as you were saying, the face value of the bonds fall as interest rates rise. So that as the Silicon Valley Bank began to have to sell some of these bonds to get necessary cash to meet depositor withdrawals, they had to do so at a face value loss. Now, in fact, if you look at the total magnitude of what they lost on their books, given the size of their assets, it wasn't too great. But what the concern was is that investors were concerned about if the interest rates kept climbing, and if the bank had to keep liquidating some of these longer term bonds that otherwise would be held until maturity, that this would be threatening the bank's real asset and ability to pay all depositors, particularly since so many of their clients, as the media point out, have been these startup companies that have front load costs and expenses with only the promise of a payoff further in the future, funded by venture capitalist investors who often insisted that the startups that were getting their money had to deposit it in Silicon Valley Bank because of the relationships they have with that bank to monitor the withdrawal, supposedly to keep the startup going while it's hopefully going to earn money further down the road. And so what has happened now really is that in guaranteeing 100% all deposits at their face value, what this means is that the venture capitalists are having guaranteed their investments against any loss based upon the inability of their lenders, the startup companies, to be able to withdraw the money from the bank. And I should point out one other thing, is that as this money has been withdrawn, and now increasingly from a variety of other smaller or medium-sized banks, where are they flowing into? The top 5, Citibank, Chase. And in fact, I was reading one thing, is that before the run really began, besides Peter Thiel telling the people on his newsletter, oh, this bank may have problems, maybe you should start withdrawing your deposits. One of the big 5, JP Morgan Chase, they particularly started making comments through their networks that, a wise decision to do would be to pull out of Silicon Valley and move into a secure place like us. So then all those depositors start doing so. Silicon Valley Bank has these problems. Hundreds of millions of dollars, billions of dollars start flowing into Chase, and that makes them even a bigger number one, with the implicit guarantee that since they're too big to fail, they're guaranteed against any problems of their own.
All right, Jim, you've done this excellent article on the banking crisis for the New York Post. It just got published. I highly recommend it. Why don't you give us your insights on what's going on here?
Well, the honest bailout is Washington's biggest oxymoron. Going back 40 years, the federal policies have disrupted, have created perverse incentives which undermined financial prudence. And so we've had a series of crashes that did a lot of devastation in the economy. It really hasn't gotten any better. I mean, the politicians still have their power, the bureaucrats still have their pensions, And so the system keeps making the same mistakes. It's interesting. Part of the dark humor as far as how the feds are trying to tamp down this latest bank crisis, confidence and crisis in banks. The Federal Reserve, the Treasury Department has said, banks right now have got roughly $600 billion in losses from these government bonds that you were talking about earlier, that the interest rates have risen, and so therefore those bonds have lost a lot of value. So what the Federal Reserve and the current team in Washington is going to do is going to value those bonds at face value, at par, instead of their current market value, which is far lower. And this is the circus shell game that the Washington is using to hide the level of bank weakness. But this makes as much sense as the creating the 1864 Confederate currency that was issued in Richmond, Virginia, magically now has full value and can be redeemed for current US dollars. I mean, that's a sham, but what the Federal Reserve is doing is also a sham.
Yeah, I think you're absolutely right. I mean, to value those instruments at face value instead of the loss that they've actually incurred is a bailout in and of itself. And Richard, I totally agree with you that this is a Federal Reserve caused crisis. I mean, we've seen this time and time again. And the Justice Department is now investigating the crisis, and darn well they're going to come up with their standard scapegoats that these were the bankers, they made bad decisions and so forth in investing in these safe and secure bonds. But I can guarantee you they're not going to seek a criminal indictment against the Federal Reserve, because the Federal Reserve is this sacrosanct institution in the welfare warfare state. We've seen this decade after decade of monetary debauchery, easy money. Look what's happened to the value of the dollar ever since the Fed was established. It's plummeted. And then there come times when all of a sudden prices are soaring in the economy as a direct result, reflecting the debauchery of the currency. So they go into panic mode and they start raising interest rates with the idea of tamping this down, throwing businesses into bankruptcy, primarily the construction business. But this time it hit not only the construction business, not only the tech business, but the banking industry as well. And I think this has put the Federal Reserve in a real tight situation now. What do? They've already promised they're going to keep raising interest rates in a very dramatic and very rapid manner because they're panicking over these enormous price increases that reflect the monetary debauchery for the past 10 years, their so-called quantitative easing. But now it's clear that this rapid, extremely high interest rate policy has caused this crisis. And so what do they do now? Do they stop raising the interest rates and then have these prices continue soaring? Or do they continue on with their policy and knowing that this is going to put increasing stress on the banking industry?
The part of this is that when we're taping this today, which is on Wednesday, people are withdrawing their accounts from a variety of financial institutions and shifting precisely into government securities. The result is that the indicators of interest rate movements, such as 2-year treasuries and so on, they're falling. They're falling, as well as the shorter term treasury notes. So as the consequence, the people's response is to go into the very government securities that were being loaded on the market that originally, as we were saying, caused the problem. But now the interest rates that the Fed has been attempting to nudge up are going down as a response to the bank failure. So what are they going to do? Are they going to allow interest rates to drip downwards, which is then opposite what they were attempting to do to slow down the price inflation? Or are they going to nudge up interest rates again, but affect the face value of all the government treasuries that are on these banks' books? Because you see, the thing is, one thing to hold those long-term treasuries until they mature, because then there's no problem. An analogy would be, well, like the housing crisis of 08 and 09. People were saying, I'm underwater. My house is worth less than I owe on it. But that only was a problem for those who had to sell their house. They lost their job. they didn't have a means to meet their mortgage payments, then you might very well have to sell your house for less than you paid for it. But the point is, if you had your job, or you had enough savings if you temporarily lost your job to meet all your mortgage payments, then you didn't have to worry about that. It's the financial institutions that have got themselves into this bind of investing long into these longer term government bonds, but now having these obligations to meet in the short term, which itself is a function of the fractional reserve system. People deposit money, you keep a fraction of it as cash relative to what you invest in. And then if people make a call on their deposits, which are payable on demand, you find yourself that you don't have the necessary cash. It's been tied up either in private sector investments or government securities in this case, and you can't meet all of your withdrawal obligations. But this is an element of the very nature of the fractional reserve system.
Jim?
Yeah, well, there's dominoes are falling, and it's the people, the policymakers in Washington don't have a magic wand to stop the carnage, and they might be able to pause it briefly, but there are so many perverse incentives that the Federal Reserve, the Treasury Department, and others have created that there's no way to. This is not going to have a happy ending. So, and I don't know how much further, how many more banks are going to crash, but I think that we're only at the start of this.
Yeah, I think that's what. Go ahead, Richard.
No, go ahead.
Well, I think that's an important thing to emphasize, that this is a systemic problem. It's not a problem with just somebody mismanaging a bank or whatever. This is a systemic problem. And Richard, you and I have been talking about it on this show for as long as Libertarian Angle has been going on. You wrote this book called Monetary Central Planning in the State. Ever since FFF was established, we've been saying this is a bad system. It's a rotten system. And I think it's important to talk a little bit about what the founding system of this country was as a comparison. We had gold and silver coins as the official money. That was the Constitution's money. There was no paper money. The mainstream press says, oh, it was a paper money system backed by gold. No, it wasn't. There was no paper money. The Constitution prohibited what they call bills of credit, which was paper money. Now, there were debt instruments, bills, notes, and bonds, but everybody understood those were nothing more than promises to pay money. And the money was gold and silver coins. There was no central bank. And banks would work together in terms of if there was a bank run on one, the others would come and help out that bank. It was all a cooperative endeavor. Now, did banks go under? Yeah. But I mean, why shouldn't banks be permitted to go under? We let companies go under. People invest their money in the stock market. And if the stock goes out or if a company goes broke, the government isn't there to bail them out. Why shouldn't banks work the same way? Well, then 1913 comes along. They established the Federal Reserve, which is preparing the basis for the welfare warfare state that ultimately comes into existence. And then in the 1930s, President Roosevelt unilaterally abandons this constitutional money. I mean, it was a totally unconstitutional act because the only way you can change the Constitution is through a constitutional amendment. He decrees a paper money standard. He makes it a felony offense to hold gold coins. And they actually went after people for owning what had been the official money for more than 100 years. And that starts this onslaught of decade after decade of printing ever increasing quantities of money. And you can look at any chart online, just Google value of the dollar since 1913, and it's just a straight line down. It was just monetary debauchery, characterized by periodic booms and busts with the easy money, raise interest rates. Then comes the recession. Then you start the cycle over again. It's just a totally rotten system. And here we are going through the same thing, major banking crisis because of the system, not because people have mishandled the system.
Since you have been kind enough a couple of times now to mention my book on monetary central planning in the state, I'll just mention for the viewers and listeners that the second part of that book is precisely on a comparison and an interpretive judgment as to which monetary system would be better for the prosperity and the stability of an economy in general and a free society more particular: central banking or competitive private banking. And this is the situation we now face. We have central banking. The monetary system is controlled, managed, and manipulated by a Federal Reserve that was established by Congress in 1913, as you were pointing out. And under a competitive free banking system, this type of crisis would have been either impossible or easily halted, because there would be competing banks issuing their own banknotes as claims to the actual commodity money that had been deposited with them. Historically, that's gold and silver. And immediately when any one bank found itself investing in some inconsistent way in terms of long-term maturities versus shorter-term liabilities, or any doubts among the depositors or among other banks, the withdrawals would start coming out, and what's called the clearing mechanism, where banks meet together and cancel out and make net transfers of what one bank owes compared to another. The clearing mechanism and even the indication of banker depositor withdrawals would force that bank to get its own house in order, or would at least decentralize the impact. That is, one bank has a problem, but that doesn't mean the entire network of banks have the same problem. And other people have plenty of other places to go with different, more sounder issued current banknotes to fall back on, as opposed to one centralized system, which offers no short-term checks and balances in the same way as a competitive private banking system, and in which you have only $1 to escape to, that is issued by the Fed moving between banks, as opposed to choosing which currency issued by a bank as a claim to actual money you view as more sounder, more reliable, and more effective for everyday transactions and investments. So the answer to this is to get government, the long-term reform, the institutional change that needs to be made, the taboo to even talk about in the world of mainstream monetary theory and policy is the institutional transformation from central banking to a competitive banking system. And one other element of this, if I can add, I mentioned that where have these deposits flowed into after leaving Silicon Valley and a few other banks has been occurring. It's been into these bigger banks like Chase, Citibank. But who are these banks? They're basically a banking cartel. They're guaranteed as being too big to fail with the government. They have these other connections between people in the Treasury or the Federal Reserve leaving those positions and moving to these big banks, or people who have been working in these big banks moving into these government agencies. It's a corrupt system of a perverse and dangerous and unethical government business partnership between large financial institutions who are always going to be protected by the government, and those in government who want to use the power of government for their own political purposes by influencing the supply of money and manipulating interest rates. So the system has to go in terms of a long-term sound and guaranteed reform to get rid of these things, away from monetary central planning with a central bank to a system of private enterprise with free competitive banking.
Jim?
Yeah, those are good points. The system is profoundly flawed, and the Federal Reserve will offer a few tweaks, or they'll have some more magic money, or pretend they've got a magic wand, but that's not going to fix the problem. And there is no solution except to radically decrease the power of politicians and bureaucrats over the entire financial system and the entire economy.
Yeah, because I praise the founding system. I mean, if you look at the late 1800s, for example, all the way up to 1913, this establishment of the Fed, that was a period of extremely sound money, because the government cannot print gold coins, it cannot print silver coins, and it was really a major factor in the extremely high rise in the standard of living of the American people from around 1880 to about 1915 or so. But Richard, you hit the nail on the head. Is it, this is a really socialist system. It's based on central planning. You've got what Friedrich Hayek called the conceit of the central planner, that they really think they can plan out something as complex as money. How much money should there be in the economy and so forth? Well, if they could do that so well, then why do they have this huge bout of price increases, what they call price inflation? If they knew what they were doing, they wouldn't have had that, and they wouldn't have had to panic And so the ultimate solution, I mean, the second best solution is what we start out with, the gold coin, silver coin standard. But the ideal solution is what Hayek called the denationalization of money, the total separation of money and the state. Just get the government out of the field of money. Let the free market decide this thing, including banking, as you point out, a free banking system, a privatized banking system. The free market produces the best of everything. It would produce the best monetary system. People could decide what they want to use. Let the market decide. Gold coins, silver coins, Bitcoins, American Express banknotes, or whatever. That's our heritage, is the free market. And unfortunately, by having moved in the direction of monetary central planning or monetary socialism, we end up with this enormous disaster. And it's not the first disaster. We've had this booms and busts for decades. In fact, if we go back to the Great Depression, what have we all been taught in our public schools and our state-supported colleges and universities? That the Great Depression was the failure of free enterprise, right? Isn't that the official story? Well, it's just not true, as Milton Friedman documented, Murray Rothbard, other Austrian economists. The Great Depression was caused by the Federal Reserve's monetary antics. That's what brought on the stock market crash. Same thing. They were raising interest rates after their big easy money policy during the roaring 20s. They panicked and they overcontracted, and that's what brought the stock market crash. But you can't expect federal officials to acknowledge that. I mean, there were people committing suicide, people losing fortunes. They had to blame it on the failure of free enterprise, and that's what they're doing now. They're going to be blaming it on some scapegoat rather than really the system itself.
I can just add one other element to understand how the current situation arose, and that is as part of this monetary central planning, the Federal Reserve has viewed interest rates as a policy manipulating tool, not as a market price determined by competitive supply and demand, to determine and bring into coordinated balance the decision by income earners to really save a portion of their income and set it aside as savings to earn a reward of an interest, so to have more in the future. And that being just balanced and coordinated with the estimate of what are profitable investments based upon a market-determined cost of borrowing. But for the over 10 years now, since the financial crisis and housing crisis of 08 and 09, we've had the Federal Reserve basically set interest rates close to zero. Now, no price is zero unless one of two conditions exist. One, something has a zero price if nobody wants it, because who's going to pay even a penny if they have no use for it? Or a good has a price of zero if it's so plentiful that no conceivable use for it faces scarcity. Well, I can assure you the savings in the economy at any point in time represents none of that. There's always people who would like to borrow other people's savings for investment in other projects that their own income doesn't permit them to financially cover. And there's certainly not enough savings to satisfy everyone in the world. So savings is always scarce, and savings represents quantities of resources that could be used in the immediate future versus the longer term future. So the market, like with any price, should be setting the price of this, the rate of interest. But the government, the Federal Reserve, doesn't permit this. And by setting interest rates near zero, they're basically distorting and creating a noise. Well, how much savings is there in the economy? And what is the term structure of the savings? Are people leaving it in just regular savings accounts, which could be withdrawn at any time? Are they using time deposits? That is, you agree to leave your money in the bank for a stipulated period of time, but with a greater interest reward for deferring any withdrawal of it for that period of time. What are the actual possible anticipated investments? There is the anticipated rate of profit relative to some market-based rate of interest, determine whether the benefit of the investment is greater than the cost of the borrowed funds. We don't know any of that. We basically had a socialized banking system in the literal sense where there's no price system at all for a decade. And then people are surprised that we don't know what is a profitable investment, what is going to go bad, how resources should be used, looking over the present to the future. It is the fact that as a system of monetary central planning, they have destroyed the very price mechanism of a financial institution that's supposed to make sure that these types of things don't happen. Prices coordinate the actions of people in and between markets. And the rate of interest is the price to borrow relative to the anticipated profits to be earned by using other people's money.
And Jim, they were aggravating the problem during the COVID crisis, weren't they?
Well, there have been so many bailouts that were spurred by horrendous federal policies. You had the PPP program, which was to compensate businesses for being forced to shut down in response to COVID. But that was basically a state and federal iron fist to wreck people's lives so that we would have zero COVID. At this point, most Americans got COVID. Almost all young school children got it. But in spite of all these sacrifices, it made no sense and were unconstitutional. But but the feds gave people money, which they printed, and which are now destroying the value of the dollar that everybody's holding. So, but these, it'd be naive to expect honest government from this kind of racketeering.
Yeah, and I don't see a bright ending in the near term here. Their debt continues soaring. It's over $31 trillion, which amounts to around $275,000 per taxpayer. That's a lot of money each taxpayer owes. And then they've got the spending is still out of control. And then you've got this Federal Reserve antics. I just don't see how this is going to end nicely. But we're out of time, guys. And thank you all for joining us. Jim, it's always an honor to have you join us. I hope you'll do so again in the future.
Thank you. Thanks for having me.
Yeah, it was great having you join us, Jim. And I highly recommend our viewers and listeners to be looking out for your wonderful opinion pieces, which appear regularly in the New York Post, but other places as well, because there's always insight and valuable information from anything that James Bovard writes.
Thanks very much, Richard. It's very kind.
Yeah, Jim, you're truly at the top of your game. I mean, the stuff you're putting out is just absolutely first class and top notch all across the internet. Jim's one of the few libertarians that has success not only within the libertarian movement, where you can find a lot of his articles, but also outside in the mainstream press. And those articles, Jim, that you're getting published in the New York Post on a regular basis, almost it seems like more than a weekly basis, are absolutely incredible. They really are helping people gain insights into what's going on. And in that regard, I would invite people to subscribe to our monthly journal, Future of Freedom. Jim has been a regular columnist for Future of Freedom for probably around 30 years. And his articles are always fantastic, not just on monetary things, but political events like Waco and Ruby Ridge, where his insights have been absolutely right on. Then subscribe to our FFF Daily, which we've strived to make the finest commentary page on the internet, and of course our YouTube channel and Libertarian Angle. So Richard, it's always a pleasure to do business with you on this show, and I look forward to talking to you next week.
Until next time.
Thanks for your kind words, Bumper. Hey, Jacob. Whatever.
Whoever you are.